Right. We'll start with new chapter. We'll talk about the stock and its valuation. Right. If you have any questions, well, you can either write here or unmute and ask your questions anytime. Right. Okay. Right. Today's we'll talk about the common stock first. Then we will talk about the determining common stock values. So I divided this chapter into two parts. Today we'll cover the first half of it. Then we'll talk about how to find the value of stocks next lecture, and we'll talk about preferred stocks in the next lecture as well. Please turn off your voice, guys, so there will not be any extra noise in that case. Okay. Try to mute. Oh, I'm sorry. Guys. I'm muting all of you. Right. Right. Okay. If you need to ask a questions, you can write it or unmute it. Right. Okay. As you all know, the common stocks represents the ownership, right? What does ownership means? That the owner of common stocks have right to elect the directors or the top managers to manage the business, right? In a small firm, usually major shareholders are the president or the chair of the board of directors, but in a large publicly owned companies, stakeholders decide the top management, right? Of course, the manager's goal is maximize the stock price and maximize the shareholders' wealth as well. Okay, we have two ways to sell the stocks. One is the IPO, which is selling directly for the first time, you know it, directly to the public. And then this, you can also buy these common stocks on the secondary market as well, which is traded in the markets. What's the exact difference between the share and the stock? Nothing. There isn't any differences between share and stock. Share is the one share of a company, and stock is used as a same terminology. There isn't any much differences. Okay. Why do companies sell their shares? What do you think? You can unmute and tell, or you can write it here. So why do companies sell their shares? What do you think about it?
I think to gain fund, to bring investors.
Raise capital, right? Right, to raise capital. Of course, for growing companies, they need capital, and this is the best way to sell their shares to the public, right? And in the secondary markets, these shares are traded. Okay, I have an easy questions. Okay, here is the questions. Assume that Apple Computer decided to issue an additional stock with the assistance of its investment bankers, right? an investor purchased some of the newly issued shares, is it a primary market or a secondary market transaction?
Secondary?
Are you sure? Be
Oh, it's
careful. Newly issued shares. Yes, the Apple computers shares are traded in the market, but these are newly issued. So since they are newly issued, they are a primary market transaction, right? Okay. Another question. What if the investor buy existing shares from the markets, secondary markets? Is it the primary? I already tell you. Is it the primary or secondary market? Of course, in this case, it's a secondary market transaction. Right? So I guess it's clear which one is the, if it is newly issued, it's an primary market IPO, primary market transaction. If it is an existing share, then it's a secondary market transaction. I guess it's clear. Okay, intrinsic value and stock price, stock value, right? You know that the companies or the top management know more information than us. So think about the Apple. The top management knows the value of Apple, everything, all the cash flows, the customers, everything. Same for the all companies. So they know more than us, right? This intrinsic value is the calculated value of a company, including the tangible assets, everything, and intangible assets as well. Do you know what the intangible assets is? Or the are intangible assets? Give me an example. Do you have any example? Yes, goodwill, for example. Right. Intellectual property. Right. The Coca-Cola name, as a name itself, is an intangible assets. Right. Or the Apple, the name, the logo is an itself, the patents. Right. So the intrinsic value is the value of all tangible and intangible assets. From outside the company, we don't know much detail, all the cash flows, everything, tangible, intangible assets, like the top managers, right? So we would like to estimate this value, this intrinsic value. In equilibrium, we assume that this intrinsic value and the stock price should be equal. Because the markets, if the market thinks that this company is valuable, the all intrinsic value, tangible and intangible assets, all value is higher than the stock price, the market price, then there is an extra demand for that company and the price should increase. Or if anyone thinks that, or the market, everyone thinks that the intrinsic value is lower than the market value, then everyone start to sell it and the price goes down. And in one point, it should be in equilibrium, right? Okay. So in this chart, you'll see the company's manager knows the company's risk and company's return, the true return and true risk. They know better than us. So they can calculate, they know the stock's intrinsic value, right? But for us, for investor, for outsiders, we don't know. So we have perceived returns and perceived risk with that company, related with that company. So we can calculate, we can see the stock's market price. In markets, this should be equal or very close, right? Is it clear? Any question? Feel free to ask. Any question? Nothing. Okay, let's move on. What if they are not equal? Well, if they are not equal, if the market thinks that stock is overpriced, what happened? If okay, let's say, what's the intrinsic value? Intrinsic value is the value of a calculated value of a company, including all tangible and intangible assets, all the factories, machineries, cars, everything, what they have. So all the cash flows, the customers, the customer relations. So they know all the data, so they can calculate the true risk related with their companies and true returns with their companies. I mean, top manager can do this. So top manager knows the stock's intrinsic value. But the market, we are, if we would like to buy an Apple, let's say, shares, we don't know. We don't know as the top managers, right? Right. So in this case, we have perceived return and perceived risk. Oh, I'm sorry. Right. So based on our perception, expectation, we can see the market price and trade with the market price. If market price is different than intrinsic value, then if you think that the intrinsic value should be lower, then you start selling your stocks, right? Until it should be very close or equal. Or if you think that the market price is lower than intrinsic value, the company is cheap in this case, in other words, you start buying that company, right? If there's an excess demand, then the price will increase until the intrinsic value should equal to the market price. So that's why it should be, if the market is efficient, all available information should be incorporated in price. Therefore, the intrinsic value should be equal to the market price. Yes, I mean, even if it is not the efficient, fully efficient markets, we expect to be this intrinsic value and the stock price should be very, very close. Not equal, but at least close. I mean, traded in almost in the same prices. Right. So let me. Let's think about today's market. You see, the stocks are in US, in UK, and everywhere. The price goes down. All the stock price goes down. Why do you think this prices goes down? Because the perceived risk and returns, yes, because of the risk, I mean, the perceived risk and returns has been changed. Now the market thinks that the intrinsic value, because I mean the companies couldn't sell their products, nobody is buying anything outside, right? So the company's intrinsic value, true value, should be lower than market price. So everyone start to selling their stocks, right? Until when? Until the everyone or the market thinks that now it's enough. The intrinsic value, the value of this company, should be same as the market stock price. If you think that both are equal or very close, then they stop selling, right? Because the risk-lover investors will claim more return in this case. Well, but you see the market, I mean, goes down, the stock price goes down, even the risk lover investors would not want to buy it. I mean, you know that if you think that, I mean, if you see that you can buy it cheaper tomorrow, why not sell today? Everyone doing the same thing, actually. Uh, my I think I mean, starting from the US, this trading, the market should be closed for a week at least, like schools. We close the schools, they should close the markets for a week, maybe more. Otherwise, it will be getting worse and worse day by day. Anyway, let's. It's a big decision. Yes, right. Anyway, let's move on. So, as an outsiders, how can we find the stock value, right? So we have three main models to find the stock value. One is the dividend growth model. Today we'll talk about the dividend growth model. The second one, the next lecture, we'll talk about the corporate value model. And the last one is the multiples, which is the easiest one. Next lecture, we'll talk about again. But today we'll concentrate on the dividend growth model, right? This is the basic three ways to calculating common stock value. Okay. Which one will be in the exam? You decide, you'll see. Based on the question, you understand which one you need to use it. Well, if you are related with dividend, if you need to calculate the expected dividend, then it's the dividend growth model. If you are calculating the cash flow, free cash flow, then it's corporate value model. And the multiples, just the multiples, doesn't matter. I mean, don't think about it. It's the easiest one. Okay, let's start with the dividend growth model, right? Okay, value of, in this model, the value of stock is the present value of the future dividends expected to be generated by the stock, right? I mean, what do I mean? You are receiving dividends each year, right? Until forever, right? So, let me, sorry. Basically, like a perpetuity, right? Exactly, right. So basically, next year dividend, if you buy a stock today, you will receive dividends next year, 2 years time, 3 years time, until forever. Then this dividends should be discounted with the expected return. I mean, okay. What's RS? RS is the required or the minimum acceptable rate of return on the stock. If you think that this stock is very risky, then of course the R should be, this R should be high. So if you think that it's a safe company, then this R should be low, right? So this R is the expected, the minimum required return for this stock. And the dividend is, of course, the expected dividends forever, right? Basically, of course, you see this is a discounted cash flow. Of course, it's not possible to find this until forever. Do we need to adjust like inflation? We'll come to that point, don't worry. Okay. Right. you know that companies pay dividends, but because of the inflation and the other dynamics, the dividends are not the same as last year dividends. I mean, it's increasing day by day, basically, at least because of the inflation, right? So we assume that we have a constant growth rate. So dividends, every year's dividend increased by the same growth rate, G. Next year dividend should be higher than this year dividend times the growth rate, 1 plus G. 2 years after, we have a constant growth rate, G, so it should be square. For T, it should be over T, right? If you rearrange this formula, if you want, I can send an additional readings how to end up with this formula. If you rearrange this formula, yeah, okay, I will send it. You end up with this growth formula, right? So basically, the previous one, like this formula, this one, until forever, with, of course, with the constant G growth rate, will become like this. So the price, today's price, will be equal to next year dividend divided by expected return, the minimum expected return, RS, minus growth rate, constant growth rate, G. Okay. What happens if G is higher than expected return? Okay. So let me explain once again. You know that this part is clear, right? Type something. Yes, okay, this part is clear. So if you rearrange this formula, you see until the infinity, it's not possible to do it by yourself, by the calculator, right? So with constant G, constant growth rate, we end up with this formula. I will send you the additional reading, how to end up with, how to reach this formula, right? Well, if I have chance to explain on a board, I try to do it by myself, but in this case, unfortunately, I cannot do it. So that's why I'm sending the additional reading. So basically, the price of this stock should be equal to next year dividend, divide next year dividend is this year dividend 1 plus more than G times, because it's, let's say, 5%. G is the growth rate is the 5%, so you need to multiply with 105, right? We have an example, we'll see. Then this dividends, next year dividend, should be divided by the expected return minus G, which is the growth rate. So yes, P0 is the present value of stock, right? This is the present value of stock right now, today's price, exactly. So if G is growth rate is higher than expected return, then in this case, the formula doesn't make sense, so it is not used, right? Because we don't have a negative price, stock price. So that's why this model can only be used if expected return is higher than G, expected growth rate, right? G is, we expect the growth rate should be constant forever. The difference between D1 and D2 is the growth rate, exactly. The difference P1 and P2, we'll come to with P1 and P2, don't worry. Up to now, I guess it's clear. Okay, let's move on. Up. So we'll talk about the CAPM, but basically we calculate the expected return with 13%. Any problem with my voice, audio? Is it okay right now? If it is, no problem. Okay. So we will talk about in this one, basically. But think about that. It's a CAPM formula. The required return, the minimum return, required return for the stock should be equal to risk-free rate. Of course, it should be higher than risk-free rate, plus the market return minus RF times the beta. Beta is the sensitivity of the market return of that company, right? So take it as a 13%. So forget about this slides. I'll explain these slides 2 weeks later in much detail. But assume that the beta is a kind of risk. Yes, we can say it's a kind of risk. For time being, assume that the expected return for this stock is 13%, take as a given, then we'll continue. Okay. Assume the D is today's dividend is $2, and a growth rate is the 6%. So next year dividend should be 6% more, which is 2 times. Let me write here, new slide. Okay, so 2 is today's dividend. Okay, D0. Okay, next year dividends up. I'm sorry. Next year dividend is D1 anyway, I guess you can see it, right? D1. No. It's difficult to write it here. Forget about the security market line. Yes, we'll talk about it later on. Go back to previous slide. This one, right? Okay, this one. So I'm sorry, guys, I couldn't write properly, so I tried to explain here. I prefer to write on board, but unfortunately, it's not possible. So if dividend, this year dividend is 2, and the growth rate is a constant with 6%, then the next year dividend should be 6% more than D1, should be 6% more than this year dividends. So how do we find 2.12? Basically, 2 times 1 plus G, which is 6%. Right? So I guess everyone can see in the chat box. So this is equal to 2.12. Right? And the following years, of course, D2 should be 1.06 times more than D1. So 2.12 times 1 plus 6% is equal to 2 point, right? It's not 6 but 7, but anyway, 2.247. Is it clear? So we can calculate the dividends, expected dividends, on each year until forever. Okay. From this, forget about the security market line right now. You don't need to just take it as a given, security market line. We'll talk about it. Forget about it. In 2 weeks' time, I will explain the security market line and the risk beta, everything in detail. For the time being, take it as a given that expected return on this stock is 13%, right? So dividend is increasing 6% each year until forever, and the expected return is 13%, right? So we have two different rates here. If expected return is 13%, how do we get 1.8761? Basically, we discount we discount this 2.12, the next year's dividends, by 13% discount rate. Well done, Letafat. Same for the second year, right? So we can find 1.7599. Basically, we discount second year dividend by 1.13% square. 13% is given, right? For the time being, 13% is given. We will see how to calculate it, but 2 weeks later, not now. So the present value of this stock is basically the discounted this cash flow, right? You discount each cash flow. So let's move on. If we use this constant growth model, next year's dividend 2.12 D1 divided by 0.13, which is the 13% given, right? Minus 6% growth rate. So this price of this stock, we can calculate the price of this stocks to 13.29, right? Why do we divide directly D1 to RS? We are discounting, Sander, we are discounting the cash flow, this one. Well, is it for, I mean, if you discount for 1 year, yes, you have to discount for a second year, you have to discount for a third year, fourth year, fifth year, and add them all until forever. Instead of doing manually, which is not possible, then we have this basic formula. This basic formula is the same as the previous one. If instead of doing forever, just divide D1, right? Next year dividends to RS minus G. So this is the one way to calculate the price of this stocks. Well, actually, why should we find the present value of dividends? It's just to show you both are equal. It's think about it's the first step. First, you need to find the present value of each dividend, then you need to add all of them, which is impossible until the forever. Then you can use this formula, right? Right. So what is the expected market price of the stock 1 year from now? Of course, expected price, P1, next year price, should be D2 instead of D1. Now we are using the following year's dividends, D2, divided by RS minus G. RS and G are given. We know that we have a constant growth, G, and RS is the expected return of this stock, which is 13%, right? So you remember it was 30.29. Now we end up with 32.10. So what is the percentage change with 32.10 and 30.29? Tell me. 6, which is same as the growth rate. You see? Because our dividend is increasing 6%, D2. So the difference between the P1 and P0 should be 6%. Exactly. Same as the G, as Nurlan said. Is it clear? So we can calculate the next year expected return. Okay, don't worry, we'll come to this point. Cameron. Right? So you see P1 is 6% more than P0. So our rate, I mean, we are expecting 13% from this stock, but next year price should be 6% more, right? But of course, the dividends increase 6%, right? Where is the value of PO? PO is here, right? You see PO is here. Why do we need discounting the D1? Because this formula, PO is equal to D1 divided by RS minus G, is the same as, this one, until forever. Instead of using this huge formula, which is impossible to do it manually, we are using this one, this formula, right? Both are the same. They are giving the same result. I will send an additional reading how to end up with this formula. It requires a little bit math, but I'm sure you can understand easily. After the class, I will send it to you, right? Is it clear, Sandur? No. We are not using 1.8761 is a part of it, is the part of this 30.29. So it's only the first steps. So if you do it for D2, D3, D4, Dn until forever and add them all, you end up with 30.29, which is the shortcut. Right? We already calculate the 1 year from now. Okay, so dividend yield, let's calculate the dividend yield. Dividend yield is the next year dividend we will receive D1 next year. If you buy a stock today, right now, the dividend will be paid you next year, not immediately, right? So your dividend will be 2.12. We already calculate 6% more, right? And you need to pay 30.29, the price, today's price. If you divide these two, your dividend yield is 7%. Okay? And capital gain, next year price, we already calculated 32.10 minus this year price divided by this year price is your capital gain, is 6%. So altogether, you'll receive your dividend plus you will receive your capital gain. Altogether is 13%, which is the required rate of return, total return for this stock. Okay, so this 13 is given to you at the beginning. We will see how to calculate it, but forget about it right now for the time being. Right, 13%. It has a two component. One is the dividend yield, because when you buy the stock, you will receive dividend, right? When you sell it next year, you will receive 6% capital gain. So altogether, your total return is 13%. Is it clear? Any question? If you have any questions, please ask now. Of course, you can keep your stock. It doesn't matter. But how can you calculate your return? 7% is your dividend return. You'll receive it immediately. I mean, not immediately, but the next year, of course. And your capital gain is based on the market price, right? If you know the market price, you can calculate the capital gain, and expected market price should be same as P1. We don't know what will happen next year, of course. The P1 is the expected return, not the actual. So we expect, and this total return is the expected total return for this stock, not the actual one. This is all expected. We calculate everything based on the 6% growth rate with 13% required rate. There might be a no capital gain based on the market condition, of course. Right? So these are all expected based on expectation. Yes, right. 13%, well, which is the price, plus dividend divided by the today's price is 13% again. You're true. You're right, camera. P2, you can calculate for the P2 as well. You can calculate this second year price, right? How to do that? Dividend 3 divided by RS minus G. You can calculate it. And based on the P2, you can calculate the remaining part as well. You can do that. Right. If G is 0, what happens if G is 0? It looks like Sandur. Well, it should be P1. If you do it with the P1, you will end up with the same numbers. If you do it with P0, like this one, if you do it with P2 minus P0, so you have a 2-year return. If you do it P2 minus P1, you will end up with the same result, same numbers, 1-year return. Okay, if growth rate is 0, then you will have the same dividend until forever. So it looks like a perpetuity, isn't it? So the payments divided by required return, RS minus G, RS 0.13 minus 0 is equal to 0.13. So it looks like a perpetuity. bonds, right? Of course, in this case, the return is lower than 30.10, if 30.20 something, right? Because we don't have any growth, so the price should be lower, of course, as expected. Okay, assume that in some extreme cases, we have a 30% growth for 3 years, then 6% growth. We have two steps. First step is the 30% supernormal growth for 3 years, then a 6% growth for each year. So how can we calculate in this case? We cannot use the constant growth model in this case because 30 is higher than 13 for 3 years, so we cannot use it, right? But it's only for 3 years. Then it's became a constant after 3 years. So it's best way to do it manually for this 3 years, like this one, right? Do it manually. The first year, our dividend increased 30%. So 2.60 is the first year dividend. Second year, again, increase another 30%, which is 30% more of D1. Third year, we have another 30%. Then starting on the fourth year, we have 6% growth rate, right? So we can calculate the D1 individually. So 2.16 divided by, basically, let me write here, 2.16 divided by 1 plus 13% for 1 year, of course, right? So this will equal to 2.30. Okay. Second year, 3.38 divided by, again, 1 plus 13% square this time, and you'll see you can find the 2.64. Third year, do it manually. Then for the fourth year, we know that starting from the fourth year, we have a 6% growth rate, constant growth rate. Then we can use the formula, right? You remember we calculate these P0 using the PD1 in the following year's dividend. So if you know the D4, the following year's dividend, we can calculate the P3, this year's price, right? So starting from P3 to forever with 6% growth rate with 13% expected return, we have $66.64 for this stock. But it is P3's value, not today's value. So we need to discount this 66.54 to today for 3 years with 13%, right? So when you discount it with 13%, it is 46.11. Add them all, the price should be 54. How do we get this 54? Once again, we calculate the 30% growth of 3 years dividend. I mean, in 3 years, the dividend increased 30%, right? Starting from the fourth year, it's 6%. So we discount these dividends individually, right? Then we find the P3, not P0, but P3 using D4. We plug the formula. But it's the third year price we need to discount this to today. We discount it today and add them all. No, we don't need to add D0 because when you buy the stock, they are not paying dividend immediately. So forget about the D0. D0 is used to calculate D1, D2, and the remaining D. So we are not adding D0. Right? If you buy right now, you have right to get dividend next year, D1, not D0. Yes, basically the price of this stock is the present value of all dividends. Exactly. Exactly. Right? Okay, one question. If we have a negative growth, -6, not the plus, but the -6, is there any value for this stock? What do you think? Either you can tell me or write here, however you like. Anyone? Ah, yes, yes, yes. Value is decreasing. Mathematically, yes, yes. I'm sorry. Yes, you are all right, guys. Yes. Why? Because still pay, yeah, even G is decreasing, but it still pay dividends, right? So still it has a value. Even G is 0, you know that it has a value. So as you have seen, mathematically, it should be minus 6%. Then we have a lower value. No, but I don't think, Cameron, because always 1 is higher than 0. Think about it. It's paying 1 AZN today, this year, and next year it will pay 6% less, 0.96 AZN, which is good and better than 0. The following year it pays you 6% less, let's say I haven't calculated, but let's say 89 kapik. It's better than nothing. Good. So yes, it's decreasing in time. Exactly. Exactly. Right. This is the last slide. This is the end of today's lecture. Any question, guys? Any problems? Tell me, ask. I will send the study questions related with this part as well. I'm unmuting all of you. Yes, now I can hear all of you, all of your voice. If you have any questions, please ask.
Belə rəng var ya. Bu çox paralı düzdür. Yəni beləsi deyil belə. Bu çox paralı. Da bu belə deyil. Bundan ayrı oldu.
Alice,
Now I can hear all of you. Any question, guys?
Ha. Kəlli. Hamısını ondan ver də. Baxdı burada xala bilər. Lazımdır. Bankasına tapın şah diye.
Hopefully I can record this today. Hopefully I can do it properly and send the link this afternoon. Next lecture will be on Tuesday, next Tuesday during the Nowruz week at again 2 o'clock. What is it okay? The 2 o'clock is okay for you, or do you want to change it? We can make it if you want 12 o'clock.
The 2 o'clock is okay.
Is okay?
Okay.
Okay,
I think
okay.
for me, okay.
Right. I will send the study questions, all of you. 2 is good, 2 is best. I will send you study questions related with this chapter, this part, right? For office hours, starting from tomorrow, I've already sent an email for each sections, so you can ask your questions. Well, if you want, we can use Zoom or Skype. I don't mind, however you like. If you are not available tomorrow, you can ask for another time. Send an email, so it's also available by appointment, right? So if you don't have any questions, see you next Tuesday at 2 o'clock. And also I'm available tomorrow morning for office hours. Yes, I will send the study questions today, right? And the additional reading as well after the class. I will send it, all of them. And the solution, not the solution, but the answer of the last 2 study questions as well. But do it, please do it by yourself without checking the. Okay. Okay, guys, then see you next Tuesday. Bye.